What's up, everybody? This is Sunko, the Korean bro. Today is 2024, March 15. Okay, let's see. Hmm. The Magnificent Seven stocks rank from the cheapest to most expensive. The Magnificent Seven stocks are some of Wall Street's largest and most influential businesses. Most investors use the price to earnings ratio or forward PE ratio as a way to value businesses, but it doesn't always work well for fast growing or innovation driven companies. Analyzing the Magnificent Seven relative to their future cash flow is the smartest way to value these industry leaders. Okay. Among Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta platforms, and Tesla, there's an industry-leading company that's far and away the best deal of the bunch. Hmm. For more than a year, Wall Street has been putting smiles on most investors' faces, right? Following bear market declines in 2022, for the iconic Dow Jones Industrial Average, broad-based S&P 500, and innovation fueled Nasdaq Composite, all three major stock indexes have powered their way to record closing highs in 2024. Although there's no shortage of factors that have fed the current bull market, such as a lower inflation rate and the continued strength of the US economy, much of the heavy lifting has fallen on the shoulders of the Magnificent Seven. The Magnificent Seven represents seven of the largest and most prominent businesses on the planet in terms of both aggregate sales and innovation. Listed in order of descending market cap, the Magnificent Seven are Microsoft, Apple, Nvidia, Amazon, Alphabet, Meta Platforms, Tesla. Aside from handily outperforming all three major stock indexes over long periods, the Magnificent Seven offers sustained competitive advantages, if not outright impenetrable moats. Microsoft is the dominant provider of desktop operating systems. Blah, blah, blah. To be often, analyzing the valuations of public companies can be subjective. What one investor believes is pricey, another might view as an incredible deal. Likewise, fundamental metrics are fluid and constantly changing as companies report their operating results, and Wall Street analysts react to this data. Nevertheless, the price earnings ratio has stood the test of time as the most rudimentary measure of value for public companies. But since Wall Street's forward looking, utilizing the 4 PE ratio, which takes into account consensus earnings per share for the coming year, makes the most sense. Based on consensus estimates from Wall Street as of the closing bell on March 13, here's how the Magnificent Seven ranked from the cheapest to priciest using this common valuation tool. To offer some context, the 4P ratio for the regional S&P 500 and growth-driven NAS 100 are 21 and 31 respectively. Based purely on earnings potential for the coming year, Amazon and Tesla appear relatively pricey, while Alphabet Meta platforms looks like bargains. The latter is particularly interesting, given that Meta has more than quantifiable since its 2022 bear market bottom, yet remains attractively valued. So based on consensus EPS estimates for the company. However, the 4P ratio doesn't provide the most complete story in terms of valuation. While it can be a helpful tool for assessing mature businesses, an even better measure of value exists for a generally faster growing, innovation driven Magnificent Seven. So this is the smartest way to rank the Magnificent Seven from cheapest to most expensive. In addition to being dominant within their respective industries, the Magnificent Seven share another trait. They tend to reinvest a sizable percentage of their operating cash flow back into their respective businesses. In other words, they're willing to forego maximum profits in the short term to invest in high growth initiatives that could really fuel their growth rates years down the road rather than relying on the 4P ratio, uh, analyzing the multiple that each company trades is related to its 4-year consensus cash flow is a considerably smarter way to value these dominant businesses. Here's how the Magnificent Seven stocks rank from cheapest to most expensive when examined related to next year's cash flow. So, on one hand, Microsoft, Tesla, especially Nvidia, are making it tougher for growth seekers to find value. Tesla's operating margin is falling as it slashes prices on its production models in order to keep inventory levels under control. Meanwhile, Nvidia is set to face a laundry list of headwinds, including AI GPU competition from many of its top customers. At the other end of the spectrum, Amazon is historically inexpensive. Hmm. Related to its future cash flow, as AWS grows in a larger percentage of net sales, Amazon could see its cash flow growth handily outpace its annual sales growth. Meanwhile, Meta Platforms confirms that it's still a potential bargain. It's just 13 forward year cash flow. So, but the best deal within the Magnificent Seven is Alphabet, which also happens to be the cheapest constituent when using the 4 PE ratio. Alphabet's foundation operating segment continues to be Google. With a nearly 92% share of worldwide internet search, Google is the logical go-to for advertisers looking to target their messages to specific customers. More often than not, this will give Google exceptionally strong ad pricing power. So, in addition to Alphabet's advertising segments benefiting from long-winded economic expansions, Google Cloud looks like a force to be reckoned with. Mm. After years of operating losses, Google Cloud delivered its first operating profits in 2023. Cloud service margins are considerably more robust than advertising margins. And enterprise cloud spending is likely in its early innings. In short, the segment may be Alphabet's prime source of cash flow growth throughout the remainder of the decade. If you're looking for a deal among the Magnificent Seven stocks, the data suggests you can't go wrong with Alphabet. So, okay, considering 4 PE ratio and PE ratio as well, it's deemed that Alphabet is um, the cheapest one out of 7 stocks listed here. 4 PE ratio is 17.83 for Alphabet and 12.53 for Alphabet as well. Hmm. Overall, slashing coverage still seems far from producing sustainable profits. The company faces cash flow challenges. Mm, it can be difficult to find attractive opportunities. These 3 stocks are all in Berkshire Hathaway's portfolio, and it still looks like it's still long-term opportunities. Or what exactly are they? Ryan, Capital One Financial. Okay, the biggest loser in the Magnificent Seven Cloud could soar 1,140% according to Kathy Wood's R Invest. Tesla stock is down 29% this year already, making the worst performer among the Magnificent Seven. The electric vehicle maker's stock has now declined 57% from its all-time high amid slowing EV sales. Kathy Wood's R Investment Management thinks Tesla's self-driving technology is the biggest reason to buy the stock. Okay, let's read this and see how this guy thinks, okay? The Magnificent Seven is a group of the world's largest technology stocks. They delivered an average return of 112% last year, led by Nvidia, which gained a whooping 239%. Um, so, okay, Tesla is stock is now trading 57% below its all-time high. Mm. The company is suffering from a slowdown in electric vehicle sales, where it generates most of its revenue, which is forcing investors to adjust their growth expectations for the future. But the head of Art Investment Management, Kathy Wood, thinks Tesla is more than an EV company. She says it's the biggest opportunity in the artificial intelligence space thanks to its industry leading autonomous self driving software. And it could propel the company to an astronomical valuation in the future. Ar's price target for Tesla stock implies a 1,140% upside over the next 3 years, but is it realistic? Tesla faced challenges in 2023, but 2024 could be worse. Tesla delivered a record 1.8 million EVs in 2023, and its Model Y became the best selling car in the world. However, with consumers struggling under the pressure of elevated inflation and rising interest rates, the company slashed the price of its EVs by an average of 25.1% throughout last year to spur demand. Given the uncertain economic climate, Tesla chose not to issue a sales forecast for 2024. Investors don't like uncertainty, and the lack of guidance is a key reason Tesla stock is down in the early stages of 2024. Some analysts believe the company will deliver around 2.2 million cars this year, representing 22% growth compared to 2023. That's less than half the long-term annual growth target of 50% consistently forecasted by CEO Elon Musk. There's some concern that demand for EVs is fading across the industry. Last year, Ford postponed $12 billion worth of investment in its EV operations, citing weak demand. General Motors scrapped the $5 billion deal with Honda to produce an affordable EV model, and the company abandoned its long-standing production forecast for 2024. EV starter Rivian Automotive issued a very weak production forecast for 2024, while announcing plans to cut 10% of its workforce in February. In its conference call with investors for the fourth quarter of 2023, Tesla offered investors some details about an affordable EV model it plans to produce starting in 2025. It will feature an entry-level price point of around $205,000 to entice consumers at the lower end of the income spectrum who would otherwise choose a gas-powered car. It could be an important growth driver for Tesla, but it won't solve the company's short-term woes. Okay, Tesla's revenue came in at a record high $96 into that in $96 billion in 2023, which marked an increase of 19% compared to 2022. Revenue grew much slower than Tesla's vehicle deliveries. Hmm. Largely because of the price cuts I mentioned, but those price cuts had an even greater impact on the company's profitability. Taking less revenue per EV sales led Tesla's gross profit margin to decline to 18.2% in 2023 from a 25.6% in 2022. As a result, its non-GAAP earnings per share fell 23% to $3.12. This has serious implications for the valuation investors apply to Tesla stock. So R believe Tesla stock could jump to $20 per share by 2027. Well, not only because of its EV sales, but also because of its autonomous self-driving software. In 2023, EV sales accounted for 85% of the company's total revenue, but R believes that will shrink to 47% by 2027, with 44% of the revenue coming from the new technology. Tesla self-driving software remains in beta mode, but it completed more than 500 million miles of real-world testing with the participating customers. It could eventually transform the company's economics in a number of ways. First, Tesla will earn a subscription fee from its consumer who buys self-driving software. Second, Musk says Tesla might consider licensing it to other car makers. Software typically carries a high gross profit margin of up to 80%, so those two revenue sources could send the company's earnings skyward once they achieve sales. And finally, Musk wants to build a self-driving ride-hailing network so Tesla's customers can monetize their cars when they aren't using them. It would operate similar to Uber, with Tesla earning a split of the revenue in exchange for maintaining the network. Interestingly, our focus doesn't factor in a revenue contribution from Tesla's new humanoid robot Optimus. Sales could begin in 2027, and Musk intends to eventually ship millions of units at $20,000 each. So it could be an enormous opportunity. Optimus could theoretically replace many human jobs in industries like manufacturing to enable plants to operate around the clock. So, can Tesla stock really surge 140% from here? Let's circle back to Tesla's $3.12 in earnings per share for a moment. Based on that figure and its current stock price, Tesla trades at a price earnings ratio of 56.2. Therefore, despite the 57% plunge in stock price since late 2021, Tesla is still nearly twice as expensive as its peers in the tech sector, represented by the Nasdaq 100 index, which trades at a PE ratio of 32.9. R's prediction that Tesla stock would jump to $2,000 by 2027 hinges on the company generating $1 trillion in annual revenue by then. In other words, the company's revenue will have to grow more than tenfold from here, or by 80.2% compounded annually. Remember, Musk himself is only targeting a 50% annual increase in EV deliveries going forward, and the company will likely fall significantly short of that in 2024. Plus, even though self-driving software could eventually transform Tesla's economics for the better, it's still in its beta mode with no firm release date. It's unlikely mainstream adoption will occur at scale by 2027. The probability that Tesla stock soars 140% to reach $2,000 by 2007 appears low. However, it might still be a great long-term investment on the back of its autonomous driving software, its Optimus robot, and its affordable EV, just not yet. Investors might do well to buy Tesla stock upon further updates on those fronts, perhaps near the end of this year or in 2025, depending on the company's progress. Next year, okay, let's see. Let's read this one. What will Alphabet stop in 5 years? Can this tech giant regain its mojo and start rising once again? Technology stocks are off to a strong start in 2024. Uh, with the Nasdaq 100 Technology Sector Index clocking 9.8% gains as of this writing. Hmm. The same cannot be said about Alphabet, as shares of technology giants are flat so far in 2024. Alphabet delivered solid results at the beginning of the year, but its ad revenue wasn't up to the market's expectations. Additionally, concerns were raised by investors about Alphabet's ability to compete in the generative artificial intelligence market after its chatbot Gemini ran into controversy. So, what controversy did it have? So, can the company turn around negative investor perceptions and deliver solid returns to investors over the next 5 years? Let's find out. So, Alphabet needs to grow at a faster pace. In 2023, Alphabet reported total revenue of $307 billion, a 10% jump over the previous year in constant currency terms. There was a drop in growth from the 14% jump the company clocked in 2022. As expect Alphabet's revenue growth to improve slightly in 2024, rising at an 11.4% rate to total $342.6 billion. Hmm. However, as the following chart indicates, Alphabet's pace of growth is expected to decelerate slightly over the next couple of years. There are a couple of reasons why that may be the case. Okay. I'm getting tired. Okay. This is it tonight, and I'll see you tomorrow. Okay. See you and have a good night. I'm doing it really short. It's just 20 minutes, but it's worth it. Okay. See y'all and have a good night. Okay. Happy Friday night. Bye bye.